Hey there everyone. So in this video I wanted to talk about some of the US tax issues and implications for crypto miners, right? So if you're currently mining cryptocurrency or you're thinking about getting into this space because it interests you, you want to make some extra money, obviously there's going to be US tax implications if you are a US person for federal tax purposes. So the starting point for all US taxpayers is everything is taxable. I mean, this is the reality of being a U.S. tax resident, right? So you're required to report your gross income from whatever source derived, whether it's U.S. or foreign, investment, business income. And so earning money through a cryptocurrency mining operation is considered gross income. Now, cryptocurrency mining comes in a couple of flavors, right? I mean, we have crypto mining, the proof of work system, right? So the actual computer is doing the mining, and then there's POS, the proof of stake. Both platforms are subject to tax, right? So if you mine cryptocurrency, if you're mining Ethereum, right, through a proof of work system, that's going to be gross income. If you're staking and earning rewards that way, that income is going to be taxable, right? And then always is the sale of it too, right? So once you get this cryptocurrency, if you then sell it for US dollars or you exchange it for something else, that sale or exchange is going to be the sale of property, and that is taxable income to you, right? So you have either capital gain or loss depending on your basis in the coins and then what you sell it for. Now, the IRS put out a notice, 2014-21, a number of years ago, and they specifically address this issue, and they do correctly point out that crypto mining is going to be gross ordinary income, right? So if you are mining crypto and you are receiving rewards, that is ordinary income that's going to be subject to tax. Now, the amount that is considered gross income is going to be the fair value of those coins when they're deposited into your wallet, okay? So if you're mining crypto and you're part of a pool, as soon as the reward is credited to that wallet address, that's when you have an income inclusion event, right? And the amount of income that you're recording is going to be the US dollar equivalent at that time it was deposited, okay? The same thing applies to almost anything else, right? Because we're U.S. taxpayers, we have to report our income in dollars and we have to pay tax in dollars. So if you're earning, let's say, British pounds because you have a London-based client, well, the British pounds, when it's paid to you, that's income, but you have to translate it to whatever the U.S. dollar equivalent is to report on your tax return. Cryptocurrency is the same way, right? So whatever the amount is that's paid to you, you always have to be converting it into whatever US dollars are, and that's how you prepare your financial statements. So let's look at an example here for John. John is going to get into the crypto mining business, and he wants to mine Ethereum. So he gets two GTX 1060s just to kind of get started, and he is going to join a pool, right? So you can mine cryptocurrency solo, or you can mine as part of a pool. Generally, the pool is recommended, right? Because you could mine solo for a very long time before you ever complete a block and get a reward. So if you mine as part of a pool, you can be certain that you're going to get at least paid something on a regular basis. Okay, so let's look at an example for John's day one, right? So day one, he jumps into this pool, he's mining Ether, and he gets 0.000064 ETH, okay? Not much, but again, he's got two GTX 1060s and he's part of a pool, so he's not gonna be a lot. The price for Ether on that day is $2,500 US dollars per coin. So his 0.00064 is gonna be worth about $1.60, okay? The $1.60, that is the amount of revenue that John would record as part of his crypto mining business, okay? It's the amount of ETH times the exchange rate, the fair value rate on that day. Now, if John decides to just hold this, for the entire year, right? He's just mining, he's accumulated ETH, that's all his profit and loss is going to show, right? The ordinary income from mining the crypto. If he decides that, well, I'm going to sell some of the ETH because I need to get some US dollars to maybe pay my bills, if you sell the ETH, then now you have a second income inclusion event, which is either going to be a capital gain or loss, right? So if John sells the ETH for $3, so that that one piece there, the 0.00064 ETH, if he sells that for 3, he's going to have a $1.40 capital gain, all right, because his basis is the $1.60. So your basis in the Ethereum is the amount of income inclusion you have when you're mining it. Now, obviously, if you're mining Ether over, let's say, a year-long period, the price is going to go all over the place, right? So the price is going to go up and down. Maybe the share of the reward in the pool might go up or down. So your basis in your crypto when you're mining is going to be all over the place. I mean, every day you're going to be earning rewards that are going to have different cost bases, right? So very important to as accurately as you can, track this. Now, if in this example he sold it at a loss, right? Let's say he earned $1.60 and then he sold it for $1. Now he would have a 60-cent capital loss, right? And then it would be either short-term or long-term depending on the holding period, right? If it's under a year, it's short-term. If it's over a year, it's long-term. Now, there's a number of ways to track your cost basis when you're selling this, right? There's LIFO, there's FIFO, there's a specific identification method where you really are tracking and selling each lot. Most people generally just revert to FIFO because they don't keep that detailed a record. So under the FIFO, it's first in, first out, right? So if you're mining cryptocurrency and then you start selling it, when you sell it, you go back to the earliest date that you started mining the lots, and that's the cost basis. Now, what about expenses? Obviously, mining isn't free, right? There's expenses incurred to mine cryptocurrency. Whether you're mining, with your own hardware, or you're renting it, or you're mining in the cloud, there's going to be some kind of cost. In this case, because John's using his own hardware, he's got a computer, he's got the GTX 1060s, he's got maybe software costs, he's got electricity. All of these costs are going to be deductible because you're running an ordinary trader business, right? Section 162 governs the deductibility of trader business expenses. So what John needs to be doing is, obviously he can very easily track the cost of his equipment, right? If he bought a computer, if he bought the graphics card, if he has to pay for any kind of software, all of those costs are deductible expenses. And then the electricity needs to be tracked as well, right? It's one of the greatest expenses for the crypto mining space. So let's say John uses one of those APC battery backup devices, which does have software on board, so you can actually track how much power is being pulled through the machine. I always recommend my clients that are mining crypto to use something like that, because you can very easily see how many kilowatts you're burning on a daily and monthly basis, and so you know how much power the machine is using. And then when you get your electricity bill every month, you can look at your per kilowatt hour usage and costs, and so you take how many kilowatts did my machine burn during the month times whatever my cost per kilowatt hour was on my electricity bill, and that's how you can kind of figure out how much electricity not only the machine is using, but what's the US dollar expense amount, because again, the cost of the electricity is a deductible expense. Okay, so that covers it for this video. I hope that was helpful. If you have any questions on crypto mining or the tax issues, please leave me a comment below. Happy to answer any I can. And I look forward to seeing you again on the next video. Thank you.